Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Intermediate Accounting, and the course code for this subject is BS 363. This is our lecture number 10, and the topic for today's lecture is bonus share and its accounting treatment. The outline of this lecture comprises of the following 4 agenda points. Number first is sources of bonus issuance. This is to mean that from which sources or funds or from capital account we are going to issue the bonus share to the existing shareholders. This general outline expresses that after listening to this lecture, the student will be able to have the grip on these 4 points or 4 phenomena or topics. The first topic was sources of bonus issuance. We will discuss it in detail, that from which accounts we are going to pay out bonus issuance to our existing shareholders. Secondly, we will discuss legal provision for bonus share issuance, that is for the public limited company. It needs to follow certain rules and regulations set by the Security and Exchange Commission of Pakistan. So there are certain rules and regulations which needs to be followed before the issuance of bonus shares. Third agenda will be quantum of bonus shares. By quantum we means the quantity of the bonus shares are the dollar amount or the rupees amount as a quantity which a public limited company is legally allowed to issue to the general public as bonus share is known as the quantum of bonus share. Let me explain once again. The quantum of bonus share means the quantity of bonus shares that a particular public limited company is legally allowed to issue for its existing shareholders. Last but not the least, we will discuss certain numerical cases related with the quantum of bonus calculation, that is the accounting treatment and illustration. Sources of bonus issuance or bonus shares. This is to inform to the listener of this lectures that what could be the sources from where a public limited company issue bonus share to its existing shareholders. So the first account from where the company can legally issue bonus shares to its existing shareholder is the balance in the profit and loss account. If the profit and loss account has certain credit balance, that is the amount or rupees available in the profit and loss account of the company, the board of directors may decide to issue bonus shares to the existing shareholders. The second source of bonus issuance could be from the general reserve, and another one is known as capital reserve. So there's a slight difference between the general reserve and the capital reserve. By general reserve we mean that company usually appropriate certain amount of profit annually from the profit and loss account and make it set aside as a general reserve, which can be utilized for different routine activities or journal losses and expenses appropriation purposes, and as well as further expansion of different projects or to pay out the routine and recurring expenses of the company. So we can take out money from general reserves. So similarly, for bonus issuance we can also use the general reserve account, and the third one is known as capital reserve. Capital reserve means that this reserves consist of the capital gain the company had made previously on its sale and purchase of capital assets. So what could be the capital assets? The fixed assets of the company are usually known as capital assets, are those assets which last for more than one accounting period and could be utilized for earning the regular routine operating income are known as capital assets. So from the sale and purchase of capital assets, if a certain number of rupees or amount has been realized by the company as a capital gain profit, now that amount actually placed or credited into the capital reserve account. Now this capital reserve account is specifically used for the buying and selling of capital assets or the expansion of projects. However, the legal provision allowed the company to pay out bonus shares from capital reserves. The fourth source from where the company can pay out the bonus shares to the existing shareholder is premium received on the issuance of shares, which I have explained in the physical classroom and as well as in my previous lecture. That if, for example, the company has issued its shares above than the par value, then it is known the extra amount company received from par value is known as the premium received on the shares. So from this premium account, company can pay out the bonus shares to the general public. And last but not the least, debenture sinking fund can also be utilized for the issuance of bonus shares. Now what is this debenture sinking fund? It will be discussed in later lectures, but for the time being, let me tell you that it is a particular sinking fund account which required the company to keep certain amount of profit or money to be kept in the sinking fund account so that at the maturity of the debentures. Now what are debentures? Debentures are actually the debt instrument which company issued to the general public for the sake of investment purposes, and on these debentures the company is legally bound to pay out the certain percentage as interest expense, but this interest expense from the perspective of the investor will be considered as interest revenue from the perspective of the company because they have taken loan from the investor. It is interest expense. However, from the perspective of the investor, because they have actually invested their money into the company, so it will be their interest revenue. So it has a certain number of years as maturity date, like it could be for 2 years or 3 years. So at the time of maturity, company is legally required to pay out the total principal amount to the investor, which could be a major problem for the company at the maturity time. So therefore, in order to overcome the stress on the maturity date, company usually make a sinking fund account, which is known as a debenture sinking fund account. And from this account at the maturity, company can simply take out all the money, which could be the principal amount of the investor, and pay out to the investor, reimburse this total amount along with their interest earned for the last period. So from this 5 different accounts, company can issue bonus shares to the general public. What is the legal provision for the issuance of bonus share? Number first, the free cash flow of the company are sufficient to permit the bonus shares after retaining in its reserves 25% of the capital, as it will be increased by the proposed bonus share. Now what does it mean? That after issuance of bonus share, the company must have certain number of dollars or rupees in its free reserve account, which should be at least 25% of the increased capital. Like previously, if company had a paid up capital of 100 million rupees, and if after the issuance of new bonus share, which could be like for example 1 million rupees, on an accumulation it is 101 million rupees of increased capital. This was our previous capital 100 billion, and after the issuance of one additional 1 million rupees of bonus shares, it is now 101 million rupees or dollar, whatever the currency is. Now this free reserve must be 25% of this increased capital, which I will discuss in my next slide. So this is the first legal requirement. Secondly, a certificate from auditor is obtained before the issuance of bonus share. That is, the auditor is must have audited the financial statement and the strength and liquidity of the company. And after the issuance of certificate from the auditors, only then company can legally issue the bonus shares. Thirdly, all contingent liabilities. Now, what are contingent liabilities? Any liability which can all of a sudden be paid out by the company from, for example, any legal case is going on into the court, and the court, after the court verdict, the company is legally required to pay out certain number of rupees or dollars to a particular party. Then this could be a contingent liability which is not sure, and it can emerge all of a sudden for a company to be paid out by to be paid out to the party claiming that amount. So contingent liabilities disclosed in the audited account should be taken into account in the calculation of this 25% of minimum residual reserves. It means that these contingent liabilities should be considered in the calculation of minimum reserve of 25%. And fourth, all existing shares must be fully paid up. Only then the company can legally be allowed to issue the bonus shares to the existing shareholders. The next topic for discussion is the very important issue, which is known as quantum of bonus share. Now, how much quantity the company is legally allowed to issue the bonus share to the existing shareholder is known as quantum of bonus share. I can say another way around, that the quantity of rupees or the quantity of bonus shares the company is legally allowed to issue to the existing shareholder is known as quantum. So in this topic, actually, we are going to calculate the quantity of bonus shares in terms of rupees and as well as in terms of number of shares. So the condition for quantum of bonus share is once again the same, that the free reserves after the issuance of bonus share should not be less than 25% of the increased paid up capital, which I will discuss in a mathematical problem in our next slide. Similarly, once again, the contingent liability should be taken into account before the issuance of bonus share and free residual reserves calculation. So after these two important conditions, let's discuss a mathematical example and the formation of a formula to calculate the quantum of bonus shares. Taken into the account the previous legal provisions and the sources of bonus share issuance and the legal requirements of auditors, we can find out the formula for the calculation of quantum of bonus share. That is to explain that the keeping in view the above condition, the quantum can be calculated with the help of following formula. Suppose the existing capital of the company is denoted by C. The free reserves are denoted by FR. Quantum of bonus can be represented by Q. The residual reserves, which was the legal requirement of 25%, needs to be kept in the free reserves after the issuance of quantum of shares, which could be calculated by FR minus Q. And finally, we need to find out the increased capital, that C plus Q, which means that the previous capital, paid up capital, issued and subscribed a paid up capital, plus the issuance of new bonus share, which is the quantum of bonus. So in order to satisfy the 25% condition, we can make a narration or algebraic expression like free reserve minus quantum must be equal to 1/4, which is 25% of increased capital. So the condition which was depicted over here that free reserves and surpluses retained after the issuance of bonus shares should not be less than 25% of the increased paid up capital. So actually we have transformed this legal requirement into this mathematical expression. Free reserve minus quantum should not be less than 25% of increased capital. So we have, rather than to write 25%, we have depicted it by 1 over 4. So the quantum, which is Q, is equal to actually 4F minus 1C divided by 5. Now how did we come up with this final formula? So with the help of simple mathematics, we can come up to this formula, final formula, which can be used to find out the quantum of bonus share. That is, you can simply multiply both sides with 4, and this 4 in the denominator will cut off. The remaining will be C plus Q, as written with the help of lead pencil. C plus Q plus 4Q. Now this Q has been shifted from the left hand side to the right hand side, and the sign of arithmetic will change from minus to plus, and as we have multiplied both sides with 4, so therefore 4 free reserve is equal to 4C plus Q. And with the help of simple mathematics like opening up these bracket signs, with the help of simple rearrangement, we can find out that Q is equal to 4F minus 1C divided by 5, as written in the next step. 4F minus 1C, C has been shifted to the left hand side, is equal to this 1Q, and 4Q is equal to 5Q. And in the final step, just leave this Q over here, and this 4F R minus 1C divided by 5. So ultimately we reach to the designated or required formula, which is quantum is equal to 4 into free reserve minus 1 into the existing capital divided by 5. Now let's take an example as illustration 3.4 to find out the quantum of bonus share issuance in a practical fashion. The following figures have been extracted from the books of a company as at 30/12/1993. The existing paid up capital of the company in year 1993, that is at the end of 1993, was 100 lakh rupees, and the free reserves available into the company account was 120 lakh. Advise the company of the maximum amount of capitalization. That is to express that this question is asking to find out the maximum amount of capitalization, that how much out of this reserve company can issue as a bonus, or legally can just issue the shares to the general public so that it can capitalize the free reserves on the basis of residual reserve test, which was 25% to be kept. After the proposed bonus issuance, the residual reserve should be at least 25% of the increased paid up capital. So with the help of quantum of bonus share issuance, we have derived a formula in our previous section, that is quantum is equal to free reserve multiplied by 4 minus 1 into the existing capital divided by 5. So the data available in this question is pretty much clear, that free reserve 120 should be added up over here, and the existing capital was 100. So with the help of simple mathematical calculation, we can find out the quantum, that is quantum of bonus share allowed to the company to issue to the general public. So the calculation is, we are clear about the Q. 120 lakhs needs to be put over here, and similarly plug the data available in the question, and with simple multiplication, division and subtraction, we come up with the Q value of 76 lakhs. It means that we can advise the company that they can issue 76 lakhs worth of bonus shares to the existing shareholders on the basis of 25% of residual test. How can we verify this? How can we verify that whether we have calculated this 76 lakh correctly, or it is a wrong suggestion to the company? So the verification could be that the increased capital needs to be find out that previously the existing capital was 100 lakhs and we are suggesting 76 lakh of bonus issuance to this company on the basis of 25% of residual reserve test. Now the increased capital will be 176 lakhs. This was our existing capital. This was the quantum of issuance we have suggested on the basis of 25% of residual test. Now the increased capital with the company is 176 lakhs. The condition was reserves, residual reserve. Residual means the remaining reserves with the company should not be less than 25%. So previously we had 120 lakhs of reserves and 76 lakh has been issued or as suggested to the company. So the residual reserve with the company will be 44 lakhs. This will be the leftover amount in the reserve, free reserve account. The condition was whether these 44 lakhs are 25% of this increased capital or not. So if this 44 lakh is 25% of the increased capital, then it will be the right answer. Otherwise we have made certain mistake. So the third step is elaborating that 44 divided by 176 multiplied by 100 is equal to 25% of the increase paid up capital. So therefore we can conclude that our answer or the quantum we have suggested to the company was correct, which is 76 lakh. Company can legally be allowed to issue this bonus share to the existing shareholders because the condition of 25% of free reserve has been fulfilled. Now dear student, we have an alternative method to find out the quantum of issuance with the help of direct mathematical algebra. That is, free reserve minus x is equal to, x is actually the unknown amount, which is quantum of shares we are trying to find out. That free reserve minus quantum should be equal to 25%, 25 divided by 100 of the increased capital, like previous capital C into the quantum which is unknown x. So with the help of simple mathematical rearrangement, we can come up that the final answer, which is unknown x over here, is once again 76 lakh by using simple mathematical calculation and rearrangement and following the rules of equations or equality sign. We have come up with 76 lakhs of unknown amount, which is quantum of issuance for this company as suggested on the basis of 25% of residual reserves needs to be available into the free reserve of company after issuance of bonus shares. This was all about today's lecture. Thank you very much for listening to this lecture. If you have any question, you can simply ask via email or simply post them on KCMS and I'll be happy to answer your question. Good luck for the day. Allah Hafiz.